Let's now go across to Jigar Mistry, founder at Buoyant Capital, is now with us. He's here with us to give us his stock ideas after the correction. He's something which he always looks at a lot of stocks, but Jigar, it would be good if you can set up the context for us. Before we talk about what names you like in the current market, can you just set up the context of Nifty? This quarter we have underperformed the Dow quite significantly. What does all of the last 2-3 months event mean for our market?
Yeah, hi, good morning. Thank you for inviting me to your show. I think, see, if you look at it in context, I think we are sort of reversing whatever the gains we have had in the last calendar year. So if you look at CY22, Nifty was up about 4 odd percent, Nasdaq was down 30, S&P was down 20 odd. And ever since they have sort of recovered, we have had to give up some of the gains in a relative perspective. But if you sort of take a step back and look at what really sort of transpires when, say, central banks raise rates across the globe, then you find that India is not such badly positioned vis-a-vis everyone else, right? So obviously, your GDP, because you have a net exports which takes a bit of a hit, you sort of give up some of the GDP gains. But over and above that, you actually gain vis-a-vis the lower crude prices, and the impact on BOP is not as meaningful. And even if you look at the recent banking crisis, I think one needs to take into account that RBI has been a lot more vigilant, right? You've seen over the past week or so, analysts have put out estimates vis-a-vis what rising yields mean to their HTM book or even the AFS book. But if you take that into perspective, the impact on Indian banks is unlikely to be as meaningful. So my sense is that yes, we are sort of giving up some of the relative outperformance, but like to like, I don't really see India getting impacted either by the recent tightening that's going around in the world, or by whatever the specific crisis that we are dealing with.
Okay, so India to be resilient, but foreign other markets are not resilient at all. In fact, we have given up pretty much all the gains that we started off with. The Nifty has turned into the red. The mid cap and small cap indexes, as it has been underperforming, so the cuts are getting deeper there. And the banking gains too have been completely reversed. There are only some select handful of stocks which are actually standing out. So let me run you through them. Tanla Platforms is good as is up a good 7%. PNC Infrastructure is reacting to the order inflow news flow. Trident, Dilip Bilkon are some of the other names which are doing quite well. On the losing side, Kalyan Jewelers and Vijaya Diagnostics are some of the other names that we are watching out for. But to the point that you were making, Jigar, about the banking space, will you still stick with the likes of ICICI Bank, or there's this positive commentary around Kotak Mahindra Bank as well? It's expected to finally come out of the slumber after doing nothing for the last almost 2 to 3 years as well. Do you look at some of the PSU banking names and the other smaller private banks as well favorably now?
Yes, Anisha. So, you break down the banking sort of the whole sector into three or four large cycles, and what's happening across the names you mentioned starts getting a lot more clearer, right? So, we are dealing with, say, a credit growth cycle, your NIM cycle, your credit cost cycle, and the valuation cycle. Now, when you look at credit growth, that's reasonably strong across the board, and therefore everybody benefits in a tide that is rising. The NIM cycle having, obviously NIMs expand when you are raising interest rates, and that sort of comes through into your relative NIMs. There you have a mix of asset which needs to be considered, but generally NIMs expand, and therefore everybody benefits again. A credit cost cycle is a very different cycle, and therefore somebody like a Kotak or HDFC Bank, which have historically, managed their credit book very, very well, have never seen an adverse credit cost beyond what is manageable. Their book to price to book multiples have always been at an elevated level. So after 2015, I think, and the subsequent rise in the corporate delinquency, the banks which were doing very well continued to do well till 2018 odd levels, and the other banks actually collapsed. But after 2018, I think the market turned into a view that essentially whatever needed to slip has slipped, and therefore going forward, what you will likely have is only retail delinquency, and there that doesn't slip en masse, right? In fact, SBI's retail delinquency is better than HDFC Bank or ICICI Bank a decade into the run, and therefore people choose to play this through a valuation cycle. So obviously ICICI Bank, which was at one time versus say 3 or 4 times for HDFC or Kotak, that caught on, and HDFC sort of flatlined and earnings moved up. So both of them are now trading at very similar valuations. SBI, which was at point 0.3, moved up to almost one time book, and a lot of us had that cycle right. Uh, a lot more sort of risky investors played this even through the PSU banks, where obviously if the incremental credit is not slipping, then why not buy banks at point 0.2 and point 0.1 time price to book? And that I think has now largely played out. From here on, I think everything is more or less evenly placed. There are not really the arbitrages which are left to be exploited. And I think it depends on what bank and what sort of liability franchise and asset franchise makes you more comfortable. ICICI, HDFC, Kotak are obviously sort of the ones that we have and like. But increasingly, I think IDFC Limited becomes a special case because IDFC Bank, continues to be in a reasonably good stead. CASA is almost at 50% now. Your legacy borrowings is less than 5%, and bank continues to report extremely strong growth. So IDFC First Bank obviously is the direct play on this, but my sense is that we'll eventually see the structure collapse, which has been announced, in fact, over the several calls. Pretty much like we have seen with Equitas or G1, and I think that similar thing will get played out, which will, I think, sort of make a lot more sense for someone to own IDFC Limited vis-a-vis the bank.
There's also a hypothesis which is now developing in the market that the phase of the macro cycle from here on will actually be better suited for MFIs and NBFCs. And in this light, if you look at the commentary from the recently listed Fusion or even Spandana, they've given very ambitious commentary, and there is some interest there. Even the NBFC space. What do you like in this space and why?
Right, Ajay. So for a lot of these players, I think things have been again flatlined for a fairly long time. Uh, NBFCs in the time when the interest cost is rising, you would want to sort of not traditionally own them because the cost of borrowing, which is from banks or money market instruments, NCDs, etc., tend to go up, and obviously most of them are able to pass it on, but it isn't a situation where many of them are able to extract the moat that we have come to expect. MFI is turning positive, I think. So from something where you have seen almost three back-to-back catastrophic events, the Amphan, the Assam flood situation, and the sort of state write-off, I think there was some moral hazard that was developing, but I think most of that is now behind us. Within the space, the player that we do own is a company called Satin Credit Care. It's around one of those mid caps, 1,000 odd crores, or rather a small cap, 1,000 crores market cap. From what I understand, almost 90% of their current MFI book is built out from July 2021. Obviously, they have very low asset durations, but this, comes 0.2% gross NPA. Your Assam is entirely provided for. The company will grow between 20-25%. So you potentially have a say FY25 13 odd thousand crore loan book, two and a quarter thousand crore sort of net worth, generating 3% ROA, which means say about 400 crores in profit, available at something like 1,000 crores in market cap. So I think that's an interesting space which is developing. This is one name that we have owned for a while now, and I think we continue to like that name.
Right. Just in terms of banking or, the sell-off that we have seen, what sort of risk would you price in for what's happening globally? Because if anything happens, FISL, and when FISL, it's almost the banking names that get derated.
Yes, I think that's a situation which is very similar to the last calendar year of 2021. Right. So back then you will have a interest rate rise which was being priced in. And whenever interest rates rise, and if your NIMs are going to sort of expand post that, the fundamental value of the bank increases, but a rising dollar sort of also brings in with itself the FII outflows. And then if you look at the largest FII ownership, they are the banks, as you rightly pointed out. So this becomes a question of the rising value of the underlying asset at a time when the largest shareholder is sort of forced to sell out, and that over a longer term always ends up becoming a very interesting proposition. So if we are not really very path dependent, as in, let's say if we are buying something at 100 rupees, the fair value of which we assess to be say 200 rupees. Then if you are not really bothered if 100 goes to 80 first or 120 first, then I think banks do sort of provide at this juncture a very, very attractive proposition. If we are path dependent, as in if we are somebody who plays on leverage, or would want to always report a positive mark to market, then it's very difficult to time as to when the FI selling etc ends. The way we approach it is that if something has higher value tomorrow than today, then we are not really worried in between what it shows in terms of share prices. So that way I think banking does provide a very interesting.
What do you like about Archean Chemical? This is a recently listed IPO. The stock hasn't done a whole lot after the IPO, but tell us what kind of numbers do you see, and why do you like this one?
Right, Ajay. So that's again one of those businesses we own about 8,500 crores in market cap. This is one of those marine specialty chemical producers, right? So bromine, industrial salt, sulfate of potash, etc. Now, there are very few sort of players globally. Red Sea bromine is depleting. So is the case with China. And this is a company with, maybe 22 Indian sort of Indian sellers, and maybe 50 overall global sort of buyers that go around. And therefore, if you look at the pricing of bromine, that's been fairly stable. This is one company that's been growing sort of the production. So what is about 24 odd thousand tons could go up to something like 42,000 tons over the next few quarters. And by that which time it will have almost 43% India's market share. So if you just plug those numbers in, your sort of earnings could more than double in the next 2 years, maybe triple over 3 years. And if we sort of come around, see, if you look at bromine in the manufacturing the process, you will find that that's not really as difficult to make, right? Just a couple of degrees over and above when you do salt. But the real fun of the business lies in the stability of the pricing. And when you have a company that's sort of available under 10 times, which is growing as fast, it does make a lot of sense. So the stock is up, almost 50% since listing at a time when nothing else seemed to be working. But I think there's still a reasonably large upside from where we see now.
All right, Jigar, thanks for chatting with us and discussing your stock picks. Let's move on and take